I want to try and answer the question, where does gold and gold stocks fit into a quality portfolio? But first, a bad joke. So a growth manager, a value manager, and a quality manager walk into a bar. After 4 hours of arguing, the only thing they agree on is that they are all underweight gold. But why is that? I think it has to do with the poor track record gold companies have at destroying shareholder value over long periods of time. Plus, historically self-serving management teams, a flat to falling commodity price for much of the past 30 years, outside of the 2005 to 2011 bull run, as well as most recently. And even during those periods of rapid rising bullion prices, like in 2011, many of the majors rewarded managements with lucrative payouts, sunk excessive capital into empire building and mergers and acquisition, or plowed earnings back into much needed development projects to sustain their mine lives. But things today are different, both for the sustainability of the commodity price and for the quality of the top tier senior producers. First, the commodity. So where can gold go? I'd be lying to you and to myself if I said I knew where gold was going. But the fundamental backdrop is quite supportive. Inflation, and more importantly, inflation expectations could finally be on the rise. Real interest rates are negative, which is a positive due to the lower cost of carry. The US dollar is weak, which lends support to bullion. Fiscal deficits, central bank balance sheets, and stimulus measures are flooding the market with ample liquidity. And supply and demand fundamentals are strong. Supply is not growing as large-scale deposits are no longer being discovered. And even though jewelry demand is down, industrial use, and more importantly, ETF and central bank buying is making up for it. But what are the risks? There are 4 main risks that I see: M&A, financial risk, operating risk, and geopolitical risk. On the M&A side, mine lives are at generational lows. So once the COVID lockdowns ease, M&A will surely heat up again. This could be a risk or an opportunity depending on the prices paid. As for the geopolitical risk, with higher commodity prices, greed seems to kick in, and governments in certain riskier countries begin to demand a higher slice of the pie. On the financial risk side, the risk is actually quite low, as balance sheets are quite healthy for the industry as a whole. And operational risk. Now, despite the odd misstep, the senior producers are generally good operators and offer better diversification relative to single mine operators. And then we have some obvious positives. Margins are at cycle highs. Generally, when bullion prices rise, a good portion of that margin gets eroded by higher commodity prices and higher labor costs. But partly due to the COVID situation and partly due to weaker energy prices, much of that top line gain is now falling straight to the bottom line. And that leads to the next big positive, free cash flow. At spot prices, even if a fraction of the unallocated free cash flow, that is the cash flow not earmarked for exploration or maintenance, gets returned to shareholders in the form of dividends, it would suggest a yield well above the S&P 500 average. So look for companies to continue raising dividends in the near term, similar to how Barrick just increased their dividend 14%. So to sum up, these are still commodity companies, which implies cyclicality. But with a positive backdrop and the increase in quality for many of the senior producers, investors will likely benefit from having some exposure to gold stocks when properly incorporated into a well-diversified portfolio. And that's even true for quality portfolios.